Let's listen in to what the management had to tell me. C Vijayakumar, CEO and MD HCL Technologies, as well as Prateek Agrawal, CFO at HCL Technologies. Thank you, CVK, as well as Prateek, for joining us on ET Now to make sense of the Q4 performance of HCL Tech and, more importantly, to make sense what the outlook is like going forward. Good morning, gentlemen. First up, CVK, let me come to you. 12 to 18 months ago, we heard from the management of all the IT majors that IT is poised for an upcycle. Where are we in that cycle? Are we close to the peak already?
Nisha, good morning. The upcycle, the trend is intact. We continue to see a lot of clients are investing in digital transformation initiatives, whether it is cloud migration, application and data modernization, security, the operating model change, and also the digital engineering, where customers are infusing new technologies into their products and services. And of course, the digital workplace, where the employee experience is becoming a very important theme. And all these trends continue, and customers are really prioritizing their technology investments to make their businesses more agile, more resilient, more secure, to deliver to their business expectations.
Fair enough. So digital transformations and cloud deals continue to drive growth going forward. But let me rephrase that question for you, Prateek. What difference do you see in the market situation currently versus 12 months ago? Are there more inquiries, less inquiries on account of the inflation pressures? Is client budgets getting impacted? Given the fact we are hearing so much about what's happening with respect to inflation and how companies are looking at allocating their funds very, very sparsely going forward.
Good morning, Anisha. So, to your question about how does today compare versus say 12 months ago or 18 months ago, I think we are in a much better place today because I haven't seen HCL delivering 5% sequential growth on the trot for 3 consecutive quarters. And the CQGR over the last 3 consecutive quarters in our services business has been at 5.2%. So my answer to your question is, this is much better than what we have seen 12 months or 18 months beyond before. And going beyond, we have given a guidance of 12 to 14% for fiscal 23. So that should also help our investors and the world at large see that we are confident about our growth going forward as well.
No, I completely take your point regarding the guidance and the services business, but it is the P&P business, the products and platform business, wherein the decline of 24% this quarter was much higher than what Street anticipated. Going forward, should we expect this kind of volatility to continue in the business, or do you expect that things will stabilize going forward?
So, Anisha, we definitely would like to see more stability just like everybody else. But it is a kind of a startup, right? I mean, we got into this business just about 2.5 years back, and it is a very large startup, of course, $1.4 billion. But it is quite possible the volatility might continue for some more quarters. We are taking steps to stabilize that. But hey, the point is that the 12 to 14% guidance factors in all of that. So we are guiding at a company level, which includes P&P, obviously. And we are sure we'll deliver within that range that we've guided.
And Prateek, what is the sense on margins going forward? Because it's no secret that the entire industry is facing a lot of supply side issues, whether it is in terms of attrition or the wage inflation that we are looking at. Going forward, do you expect things to get worse before it gets better?
I think things have started stabilizing on that front, also on the attrition front. Definitely on a last 12-month basis, that is how all of us report the attrition numbers. We came in at 21.9, so That was an increase of a couple of percentage points versus last quarter. But then the change of the quarter is what is making that happen. On a just for the quarter basis, I think things have stabilized and hopefully starts going down in the next few quarters as well. So things are beginning to stabilize. Again, our margin guidance factors in all of that, and we have guided 18 to 20%. As you can see, our last quarter of the previous fiscal or March quarter is at 17.9 for the company, and therefore we are towards or just a little short of the bottom end of the range for next year. So yes, we expect this to improve during the year and be within the range for the full year.
Prateek, just wanted to, delve down deeper in it, because my question was more from the point of view that you're at 17.9% right now. For Q1 and Q2, should we expect a lower number and maybe some sort of recovery in H2, or do you think that already you are seeing signs of recovery and the 17.9 can already jump up to, let's say, 18 to 19% band in the coming quarters?
I will prefer not to get too specific about individual quarters. The way we give the guidance is for the full year, and I'll let it stay there. Individual quarters could obviously fluctuate, and you definitely seem to have an inkling of what can happen.
Fair, I had to try my luck there and try to get more details, but as you rightly pointed out, it's difficult to imagine how things are going on as we speak. But CVK, what about the TCV pipeline? Over the last 3 to 4 quarters, the number has been around $2 billion thereabouts, 2.1, 2.2, somewhere around that range. Is this what we should expect going forward as well, a run rate of around 8.5 billion for the entire year?
Yeah, see, the way we report our bookings is new deal wins, both in existing clients and the new clients. So this is a pretty healthy new booking numbers. It increased 14% year on year. And as you know, the nature of deals are also changing. There is a little more concentration of smaller deals into the overall pipeline and in the bookings. Our ACV, which is the annual contract value booking, is up 21% year on year. So there will continue to be a good growth in our new TCV wins, both from a TCV perspective and an ACV perspective.
Prateek, what are the levers for margins going forward? You have been making a lot of investments in talent as well. The realizations, if you can give some color on that, are they improving? What are the basically levers available for margin expansion going forward?
So Anisha, you rightly pointed out, we are both investing in talent, and those costs have been coming upfront as which is true for the whole industry, right? Whether to combat attrition, whether to retain the people, or hire the laterals from outside. And we are investing as a company in freshers in thousands, and increasing on a last 2 years, we've been increasing 50% intake of freshers every year. So, those costs are obviously there. But the good news is that clients are receptive to our requests for price increases, especially on the Mode 2 services, the cloud and the digital and, the DWP, the digital workplace kind of work. So we are hopeful that in a few quarters that should start becoming a meaningful, uptick, giving us a uptick in the margins going forward. But again, like I said, it's all factored into the margin guidance.
Okay, fair enough. And CVK, what about the headcount addition trend? Because this year and this quarter also, it was very strong at 11,500 people. Is this also the run rate we should expect in FY23?
Yes, of course. Since we've given a 12 to 14% guidance, there could be some moderation, but I would expect ballpark in a similar numbers.
Okay. And lastly, just to talk about the various segments which are there, BFS, retail, etc., which are the various verticals where you are seeing much growth coming in life sciences, etc.?
Yeah, I think our three top verticals are life sciences and healthcare, telecom, and financial services. All three we would expect to really be leading performing segments based on the pipeline. Of course, other segments as well, retail, CPG, manufacturing, all of them will contribute to the overall growth momentum. The essential aspect is the growth momentum, the demand is all very secular across the segments. And I think not only segments, but geographies and service lines. I think that's what is giving us the comfort to provide a 12 to 14% revenue guidance for FY23.
All right, that's the management of HCL Technologies talking about a plethora of topics, including their numbers as well as the outlook going forward.